Welcome, guys. Welcome, everybody, for tuning in and tuning in from both social media, our Spotify account, our YouTube account. This is the first podcast of 2024, and we've got some special guests here today. I really wanted to make sure that they were available. They've made themselves available. They are esteemed partners of our of GeoNet Properties and Finance. The reason being is because they help us with so many of our clients, and they've come to us now to sort of kick the dirt and to find out what Bali's actually like. And I couldn't be more happy to have both Lewis and Jaka in our studio today. I've got some pointed questions for you guys. I really want to make sure that we have, I guess, your answers to things that are going on in the Australian finance situation. And Australian investors are facing a lot of issues. You guys are there to guide them through. On the screen here, we've got your website. I just want to quote one thing, which I believe is very, very true. Even if it comes for you, sure, it sounds a bit egotistical, but I can definitely attest to the one statement here: not all mortgage brokers are cut from the same cloth. And I kind of want to bring that into what brings you guys together as a team, and why are you doing what you do in finance?
Yeah, I think, well, first and foremost, look, Lewis and I, or Lucky as we call him, we've known each other for a while. We were both ex-bankers, now getting into business together. I think we found that the two of us have played a very yin and yang role, allowing us to really build this business up to the point that it is today. But, being in finance my whole life after doing a science degree.
Wow.
Completely different.
You did a science degree, mate.
Yeah, man, that's why I'm such a dork. But I know numbers, that's one thing. Yeah. But finance, I find that, I guess why I do finance personally is it allows people to get where they want to be. It allows them to achieve their goals. Because I think the struggle of being able to fund things yourself is a very long haul. It's a long slog, and I think to be able to enable people to leverage off financial tools, financial instruments out there, educating them and allowing them to realize their full potential, that's what gets me up in the morning.
Yeah, that's awesome.
My thanks, Jack. Yeah, so me and Jack's been in business now for a while, but my background has been a little bit different from Jaka's. I was actually a performer. I was a dancer. I was a singer at one stage of my life, and then I was a high frequency trader. And then I managed some funds. But I think what I play in the business is a common understanding where people have to understand certain financial instruments in a way that they get it in proper language, in stuff that could be absorbed easily.
Right.
I think in finance, it's where do you start, right?
Yeah.
Totally. And a lot of people just get confused. Like my parents are immigrants to Australia, and they just didn't know where to start. And a lot of people have conversations with other brokers or the banks, and they even after an hour worth of conversation, they still don't know what it was. So the goal that we wanted to instill to all our clients and to everyone that we work with is, how do we make finance understood in a way that they understand?
Yeah.
And that's what I think makes us a little bit more different to a lot of brokers and a lot of banks, where there's a lot of lingo that's not really broken down in a way that they can absorb.
And I can self-confess, for the first 30 years of my life, financially illiterate. Didn't know why I was saving and spent flippantly, realizing by my 40s this was not sustainable if I wanted to actually achieve some things. So I think financial literacy, and the fact that it's a passion of yours, and the way that you're now going about your client interactions, you're coming from that position of, there's people out there that are just being hoodwinked by the jargon, hoodwinked by the process that the banks put you through, but have never been able to go and confront that fear of, I don't know, I just know I need a mortgage and I need to own my own home, and we'll talk about the rest of it later. The wife's better than me at budgeting, that kind of thing, right? So I can imagine in your process, you're making things sound a lot easier for them to achieve. You're opening up whole new paradigms of what their existence and their wealth could be. Because from a day-to-day basis, a lot of Australians, I would say more than 50% of Australians are just living to pay their bills, right?
That's what they're taught.
That's what they're taught.
Yeah, you know, again, I want to go in with you know, my parents being immigrants and coming to the country, and wealth generation was never a topic of conversation. Their conversation has been, I arrived to the country, I buy a home, introduce your own dream, I pay down that home, and then I get to live, which I thought was great at that time. Look, it must have been, you know, what they really wanted to absorb then, but you know, we wanted to do things a little bit more different. And if they knew, they probably would have done things differently. Yeah,
yeah. So take me through the early parts of Financebetter and your partnership here. Who became your first clients?
Far out, what a question. My first clients was my next door neighbor.
Wow.
I still remember her. Her name's Umesh Kumar, and I knocked on the door and I said, "Hey."
You knocked on her door?
Yeah, I said, "Hey, I'm a broker now. You knew me for a while. Can I refinance you?" And that was the first client that I've ever had. That I said, "Okay, this is it." And yeah, that was nearly, I think, nearly 11, 12 years ago. And obviously we built it to what it is now. But yes, I still remember those first clients, and it's a beautiful thing. So,
it is.
And we grew that pretty organically, which is great. We have this, I call it the hot tea strategy.
The hot
tea.
You drink hot tea. I've been out with you. I've been out with you.
The hot tea strategy. And the hot tea strategy was, I used to go to their house after loan doc signing. I said, "Can you make me a hot tea, please?" And they would make me a hot tea. And it would have to cool down. And to you know, get my client base, there wasn't, you know, heavy on Facebook back then, or heavy on Meta, trying to get ads. And I used to go, "Make me a hot tea before the last signing," and I would sit there and say, give me 10 to 15 of your friends' names. And as the tea would settle down, because I already made it, they'd had to give me 10 to 15 names, and I would call them up, and I would call them and introduce myself and say what I did for Umesh, and that's how we grew it.
That's fantastic. So that's, you know, we speak about ads and we speak about getting your name out there, but it comes down to it that word of mouth is the best way of advertising, and it's the most organic, as you mentioned.
Yeah, absolutely.
Yeah, and your first client?
My first client, look, I was expecting that it was going to be my family, but I'm sure, you know, most people realize that, you know, they're probably the last ones to come on board. But I ended up getting some old colleagues of mine, because obviously working at the banks, I was actually training brokers at one point.
Right.
So my colleagues knew my capability.
Right.
You know, I was probably one of the first, you know, from my colleagues to jump out and get into broking, and so they entrusted me to do it. And obviously understanding both sides, you know, the client's experience and understanding the back end process, then they knew that they trusted me to you know, deal with the process. And again, word of mouth, then one after the other. Of course, asking for referrals, and then finally, family came around to it as well.
Fantastic,
yeah.
Fantastic. And back to this one, not all mortgage brokers are cut from the same cloth. Give us the gambit of the extreme to the ridiculous. What happens out there?
Far out, where do we start? Look, like, we know what our capabilities are. We've done a lot of, I've come from, again, institutional lending. We understand the scope of it. It's a lot of brokers have come into the market, and there's nothing wrong with it. I think our industry is great, but a lot of mortgage brokers have come into the industry. Excuse me. And they've had this massive expectation on give me 2 pay slips and here's $1 million, right?
Right.
And because a lot of brokers have come from, you know, previous banking experience where people were just numbers. I used to work at a bank. I wouldn't say which one, but Big Four. And the goal was not to help people. The goal was to get people through the door, write the business, and then on to the next one. And some people have adapted that into broking now. where it's just like you just become a number and then on to the next one, right? It doesn't become a long-term journey. Like right now for us, I feel deeply passionate about the clients and their success. If they don't win, we cannot win. Very, very simple, right? So we've really adapted that, and I feel it with my bones, I feel it in my heart, I feel it in my DNA. That's the case. So what I think broking industry needs now is a sense of love and passion that has to be formulated to the client to make sure that they win at whatever they do.
Yeah.
So complex stuff, yes, obviously is just one, but we've just been gifted to be in a starting our broking careers at a place when there wasn't that many competition, and we've been fortunate enough to see the easiness of broker or easiness of credit than the challenging parts of credit, which is what it is now. So I do believe that there's certain brokers for certain people.
Right.
Nothing wrong with that, and I think that's fantastic. But the people that and the clients that we deal with, or I deal with, or the team deals with, we are invested wholeheartedly in absolutely everything. They need to win. And if they don't, and we can't get you to win, we can't accept you as a client. Because for us, it's about them, getting to where they need to be. And that's where I've got goosebumps about that.
Yeah, I can feel you there.
It is, yeah, because again, we take the stress away from what they're trying to do.
Yeah.
From as simple as refinancing, the simple as or wealth creation or guarantors or first homes or first investment, we want to see it through. And there's going to be times when, clients and us do butt heads, but it's about educating, going, this is what's going to be good for you. This is the reason why we do it, and this is how we structure it. And then once they got it, and once they, finally get to that end zone, they're like, this was what I really wanted to do. And I'm just like, yes. And we do that over and over and over and over again. So that's why I think we're a little bit more different to a lot more brokers out there.
Because there's for me, there's a million of them. I've got probably, I could count them, but it would take more than two hands of close friends that are in that game. Yeah. Okay. Most of them just process applications.
Yep.
Where do you differ there? Over, above, or is it just an application process? I know you guys take full ownership of what their strategy is and that you want them to win, but you must have innovated around that role of processing an application to make it more possible to understand the dream, to understand the strategy, or to formulate the strategy, to communicate that strategy, and to help them to feel like they're on board with their own tailored situation. Their income, their assets, their goals, their expenses. Take us through what else goes on.
I guess I'll answer it quickly. I know Jack's eager to we're all J'd up here.
Come a bit closer.
I think that's it though. Like you said a couple of things that you said, applications, assets, liabilities, expenses, etc. Right? Which is let's call it the box, right? Inside the box is mandatory. What you need to do from a compliance point of view, what you need to do, what you need to understand. Where's all the creative stuff outside? Right? How do we get the clients to? I might not answer this question straight, but
I've never thought of this as something that you could get creative with.
You can.
So, give it to us.
Sure. So, for example, I've got a certain client that may go, look, Lucky, I want to get my first home. I'm just like, okay, cool. Let's talk about inside the box. Your expenses, your liabilities, what you want to do. Inside their box is their thoughts as well, right? How do we then get them to think outside that box? How do we go, you know what, you could do a first home, and that's great, and you could borrow your first home at $550,000. Have you thought of potentially looking at investing in a certain area that you probably wouldn't be able to do as a first home, say $700K? Have you thought about potentially living with mum and dad right now? It looks like, you're single, you don't have that much liabilities or kids or any dependents. Have you thought about that? No, I've never thought about investing first. Why haven't you thought about potentially investing first? Because everyone around me says to buy my first home.
Exactly.
Right, okay, cool.
Exactly.
So what's inside the box isn't even your own thoughts.
Exactly. It's just fed to us.
Exactly. So as a professional that comes together, we go, well, okay, if this is what's inside your box, how do we creatively think outside that box, right? And then they go, wow, actually, I didn't think that was possible to begin with.
It's never been presented to them.
Exactly it. So, like, you may go, like, that's not very creative, but you're like, actually it is. Because if you had someone fixated for the last 5 years within their thoughts of a specific angle, and you switch that just a little bit, that's creativity.
You're changing the trajectory of what they believe is possible in their life by getting them to think outside of, okay, I get this application form, I put that over there, I buy the house that everybody thinks I should buy. But you're actually giving them a lot more context to what investing is.
Sure. What I mean is like,
I think a lot of the conception of finance is generally that finance is like a checklist, right? You walk into the bank, there's a criteria, you either meet it or you don't. Now you walk in either happy or you come out bummed out and your dreams shattered. You know, the good thing about us, not just the two of us, but our team, we've walked the shoes of all our clients. We've been there, we've done that, we've seen the struggle, we're investors ourselves, we've developed ourselves. So we walk the shoes of our clients and we're there for the journey. And so I think when we talk about the element of creativity, it's about creating a plan for the client. So, if the client wants to go buy their home, they might not be able to say do it now, but if we can create that pathway for them through doing things like maybe getting to an investment first and building some equity, or creating a savings plan, I find that our clients appreciate us when we can articulate it clearly around, here's the steps to get you to where you want to be. It's not just you don't qualify, it's this is what we need to do now, and this is what you can do now. And I think helping them realize that opportunity, helping them realize, keeping them focused as well. And look, let's be real. I mean, some people might think that the loan process, like the general public, might think that the loan process is quite simple. But we've seen thousands of applications. We know what works, what doesn't work. We know what we can say to the lenders, but it's then being able to, I guess, structure it right and ultimately getting them to where they want to be. At the end of the day.
Yeah, awesome. So, I mean, there's the big four. How many lenders are there out there?
Jeez. How many pages you got if you want to start writing it down?
It's like that.
Yeah, it's like thousands. There's thousands of product. There is more than, there's 40, 50 lenders. There's heaps and heaps and heaps of options. Again, going back to it, some brokers don't even know this. They would call themselves brokers, but they don't represent two banks. And there's nothing wrong with that. Again, like, I don't want it to seem like I'm bagging on brokers here because I love the industry, but you go, okay, cool. You work with those two banks and you work them very, very well. Great for you, but what about this client that for a fact is good, it should be going elsewhere? I think our team really invests a lot on education around credit and education that has to stem not only from the senior guys, but every single person in the team. So when we do get a scenario, that we really compare it, we really do our due diligence, and not play any favoritism with any lender. That's the whole goal of building a great strategy, is to make sure that you could equip yourself with multiple things, with multiple lenders on your disposal. So when you can execute that plan, it's executed properly with more than the one lender that you knew about. But yes, that's a common question. Everyone's like, oh, there's only like 4 lenders. I'm just like, nah, man. There's heaps you even know about.
But it's also about understanding the policies too, right? As brokers, you think about your lenders as your toolbox. You've got all these tools in there. Right? You might only, some brokers might only know how to use 3 tools. But we go deep down into each policy, so we know how to.
Right. So, I mean, you two are rock stars, in my opinion.
I appreciate that.
Rock stars, and I mean that on a level of awe and wonder, and your what you do for clients makes us feel, especially now that we're in partnership with our clients, and it's always felt like that, this relationship. But I have obviously a very, very big respect for a good rock star needs a great band. Who's in your team?
Man, let's go. So
Talk a bit closer.
okay, sure. So we basically structured it. We'll go through the process. So we've got myself, which is the broker. We've got brokers, and then we've got wealth managers. And then wealth managers is your think of your client, a concierge. Just kind of
A concierge.
a client concierge, and that's just because sometimes I'd be in more meetings and the client wants to speak to someone straight away. Usually we work in 1 to 3 small senior teams on one client. So we have multitude of people kind of jumping in. And then we'll have someone collecting the documents, compliance. We'll have someone doing servicing, policy checking, review. We'll have someone saving documents, someone collecting documents. That's probably the hardest thing, collecting documents. We built some tech around us to help with that process, which is great. We've got our own assessors, internal. Those assessors help us assess deals quicker, application inputs, straight to settlements team. So altogether, there's about 15 people, but within those 15 people, it's a nice streamlined way to do it. And this didn't happen overnight neither. There was a lot of trial and error that we did do this. It's probably been maybe 5 or 6 years in the making to get it to where it is now, where we can kind of handle processes at volume, but still not let go of that personal factor. So yes, that's
a fine line.
Man, it's definitely a fine line, and we experienced that early on. I'm not gonna say that it wasn't challenging at the start, where clients were like, oh, who do I speak to, whatever the case is. But now with a built concierge team and our process team and our settlements team, like we've really focused on that. But Jack hates it in the office because he's like, Lucky, there's a new process today. And I'm just like, yeah, well, we have to change. We've got to adapt with the market. It is what it is. So every Monday he's like, what's new today?
So let's go further into the Australian market. There's what's changed in investment strategy? What are some of the things that have become, obviously, not just process changes, but strategy changes? Give me some of the highlights or the lowlights of what's happened in the Australian market over the last few years.
Yeah, I think, look, there's definitely been more investors coming on. People have started to think about investment or investing in general more so. We've started to see the spread of wealth move between states. We've seen the property market's pretty saturated with investors. We see it ourselves. We see that some clients struggle to find properties as well, and I think that's come from the growth in property values over the last couple of years. Coming off the back of COVID, people realizing equity. It's interesting. We speak to, once upon a time, investors were people in their 30s up. Now we're speaking to people straight out of high school, 18, first job,
early 20s.
Thinking about investments, and I'm talking to these guys thinking like, I remember when my goal was just to get into a pretty decent car.
Ours was a 21.
But now these guys are thinking about property portfolios. So I think the conversation around investments have become very broad, and it's a common conversation. People are talking about it more, and so obviously it's a topic at barbecues. We see it everywhere. Or clients see it on social media, and so they're almost being bombarded left, right, and center.
Interesting, that algorithm and how it can speed up the education, or at least the transition of somebody's fleeting thought to something that can actually dominate their content, their content consumption.
Exactly, and so they only know what they know, right? And I think in the age of social media, they get fed into one sort of stream of information, and then they'll just constantly get bombarded. And so their perception of an investment property is what they're exposed to. But the reality is, there's all different investment vehicles. There's all different types of investment properties. And I always say this, a good investment property for someone might be terrible for somebody else. And so it's got to be on a case-by-case basis. Everyone's got different time frames, so people have different risk appetites, people have different, situations in life. So, there's opportunities everywhere, but it's definitely a conversation piece with everybody we speak to now.
Yeah. Affordability has always been something that was tied to the finance process. Affordability now contextualized today. What are we seeing in affordability, and how is that affecting just your clients or the Australian market on the whole?
Yeah, I think, look, affordability is the thing that's being discussed all the time, being evaluated. If we look at, I'm from Sydney, we look at the average house price, above $1 million.
Yeah.
Now already, saving for that. I think the rate of growth for property outpaces the rate of savings for most, and especially those first home buyers.
Yeah.
So it's definitely affordability is a big issue, and this is why we're starting to see, I guess, people being more open to the idea of investing. This is why we're starting to see people shift to other markets within Australia. But at the same time, it's, how can we also expand and broaden their opportunities as well? There's opportunities everywhere, and I think to address some of the affordability things, affordability issues, like, number one, do you go get a higher paying job? For some, as possible. For some, it might not be as easy, but you can get to your savings goal, or you can achieve what you want to achieve through investing. And so I think, the investment conversation piece addresses that affordability. And I'll give you an example, right? Investing in the right property that yields a really, a good return.
So cash flow.
Cash flow, yeah. Cash flow, it can help you pay down your mortgage. It can help you get to your savings goal so much quicker, because what's the cash rate at a bank now? Maybe 4.8, 4.9%? If you're lucky. If you're lucky. And the reality is too, like, there's some good investment properties, but to find some really strong positive cash flow in Australia, it's starting to get a bit tight, because all the properties are
starting to get a bit tighter. Our entire ideal profile of a client is 80% of Australian investors, to be honest with you, because we have over here in Bali that cash flow positive opportunity. We'll get more into that a little bit. I just wanted to sort of bring it down to you. The Australian dream was always own your own home. Yeah. Okay. That was the wealth strategy. We're all taught that.
Pay down the mortgage, that's it.
Pay down the mortgage. Okay. How's that evolved now? Because the equities position of a lot of Australians is better than it's ever been, which also makes the affordability for the first generation, or for today's generation, a little bit hard, because they don't have any equity behind them. They can't get back into the market. Explain to us why that has become an issue. Interest rates, I'd like you to speak to that point.
Why interest is an issue at the moment now?
What we've seen in interest rates and how that's affected the affordability and the equity position.
Of course. Let's just go to it. So interest rates have been climbing pretty aggressively over the last, say, 2 years, 24 months. Every single time, every single month that those rates have increased, our borrowing capacity for our clients decrease. So they may have the equity position, but if they don't have the income to take out that equity, it becomes a hard conversation to do. So let's talk about interest rates. Interest rates has been growing for the last, say, 24 months. And people, obviously, when it first started, everyone was like, oh, it's okay, we'll just sacrifice a couple of things. But now it's got to a point that, yes, affordability is a big conversation. Now, people do have equity, but the big thing regarding it is servicing, right? Some people have enough servicing to take out that equity, but they don't have the servicing to potentially invest in, the property that they see as valuable at one specific time. And that has made it pretty hard. But yes, a lot of people right now, though, they can, servicing has always been an issue. It's always been a point of conversation during these rate rises.
Especially if there's no cash flow.
Correct.
Big one.
Especially if there's no investments that are producing money, right?
Yeah, 100%. And the thing, though, is how much can you pump up the rent, though?
Yeah.
Right? Like, yes, the rent. There's also a rental crisis happening in Australia at the moment, but is that enough to offset the interest rates and the investments, or the cash out that you've done, or the equity release that you've done to acquire that security? Look, in some cases it works. In other cases, it doesn't. But yes, like that has been the biggest conversation, which is how do we find investment opportunities that can give us a better cash flow position
which makes sure that they are self-sustaining off the equity that I took out, as well as the debt on the security purchase or the security that I've invested in. And what tax minimization strategies can I do to really action that? I think that's what we that's the biggest challenge that we see at the moment is how do we find great investment opportunities for clients to make sure that those two topics are fulfilled.
Right. Welcome to Bali. That's kind of where it's going.
Exactly.
So we can liken this to the Singapore market. Okay, the Singapore market was great for those that were already invested. Now there's nothing for them to invest in anymore. They're all investing overseas. It's been like that for 20, 30 years over there. Seems like that's where we're at right now. This is a really big moment of truth for Australian investors. A lot of them are pulling out of their investments. They can't afford them anymore. Interest rates got too high. We've solved a couple of these issues over here. We saw, as Geonet Properties, we saw the opportunity to, first of all, great cash flow, incredible cash flow, either every quarter, every month, or every year, depending on what you're buying. What we didn't have, though, until you guys came along, was that ability to access equity in Australia and to get back into cash flow positive properties, even at a fractional rate. We'll go into fractional a bit more. But I'd love to sort of get, maybe you can tell me about the light bulb moment when it came to assessing what we were doing here.
I think there's a couple, and maybe Jack could explain it a little bit further, but there's a couple. The first one was we saw the cash and cash return. That was...
Explain cash and cash return.
Cash and cash return, how much cash you put in towards how much cash you're going to... Very simple. Put out, right? And how much cash flow you're going to do. So right now, yes, a big concentration has always been capital growth, but because of interest rates being where it needs to be, cash flow has been the biggest conversation. How do I take care of my debts and my lifestyle without having, and still investing without having to break the bank? So that was the first one. The second one was valuations, which we'll probably get into a second. That valuations in Australia, you're basically capped at what the valuer has tell you that the property value is, and that's been hard for a lot of investors, especially because we're based on property data. Sometimes you may see a location in say Australia, and if there's not enough data on that, you might have short valuations, which is again not good for investors. But what we're seeing here in Bali is a lot of the conversations or a lot of the challenging things in Australia be depleted, actually.
Take us through that.
Well, I think because we're not building enough houses, right, in Australia to meet the demand. Hence why property prices are going up, and hence why that affects the ROI on investment property. But there's still a lot of growth potential here in Bali, and the fact that it's an international market as well. Spending the last couple of weeks here, seeing, meeting the people around here, not just the locals, but the type of, the tourists that come here as well. It's made its mark on the, in the world. And people fly from all over the globe to come to Bali. It was nice to see that the developments are coming up to fruition and dealing with established and reputable developers. Some of the projects are just amazing, and I think what like you mentioned around cash on cash, when we talk about equity release, I think the biggest concern for some investors or even new investors in a rising interest rate market is, well, how am I going to afford this? How am I going to pay this? But if we're talking, you borrow money for 6% and you're getting back 8% during construction.
Just so that you guys know, 8% during construction is what we offer on all of our premium projects. Yeah. That's a mechanism, right?
So it's paying for itself. It's almost a no-brainer. But then once it's complete, we're looking at almost doubling that. And it's interesting because now that changes the conversation. Because look, let's be real. Not everyone wants to invest, but everyone wants to pay down their debt. Right. So if we can realize that equity, make that extra cash flow. That cash flow can then pay down your mortgage.
And we're talking how much could they possibly shorten their mortgage? It's a 30-year term generally, right?
Yeah, 30-year term. We did some background numbers, and we could probably do it within 7 to 10 years, 7 to 11 years, depending on the debt. But
massive.
We saw a couple of ways that using offset account and accelerating the payments because of better cash flow. Yes, could pay down the mortgage a little bit shorter. There's actually one thing I wanted to add. The equity position, right? Like, a lot of people have been parking their equity in their home, parking their equity into another investment property in Oz, but it's just about parking equity. Now's probably the opportunity where you can park that equity here. Now, I guess the maybe it's just an immigrant mentality, but an investment doesn't have to be forever, right? Like, parking money or parking equity may suit you for the next 1 to 5 years. Maybe when we see rates kind of soften in Australia, and you want to go back into the Australian market, you know, you could liquidate here and go there. It's just about where's the best way to park that equity. Where's the best way to park that money?
And to that point too, equity. People take pride in the equity that they have in their homes, but if you're not using it,
it's not paying the bills.
Exactly. This is the biggest mistake people make. They know they've got, let's call it, $500,000 in equity in their home, but if they're not touching it, like, things can change, right? And we've seen this happen, and this is why the conversation's always, if you've got equity, utilize it, because if you don't, things could happen tomorrow. Rates could rise tomorrow, but even worse, let's say rates don't rise tomorrow, banks can change their policies tomorrow. And we saw this in a low rate market where the banks tighten their criteria.
Wow.
And then so you can't,
policy.
for cash out policy. And so
restricted it to like 100 gigs.
Yeah. So what good?
Wow.
Yeah. So what good is $500,000 in equity, knowing that you've got it there if you're not using it, and then tomorrow that you see the perfect opportunity, and you're like, well, actually, the bank won't approve me for it. So, it's always important. One of the conversations we like to have with our clients is helping them realize, number one, well, how much equity that they have, but also,
what can you do?
What can you do with it? What can you do with it now while you can?
Yeah.
And what bank policies are available now so you could take advantage of that?
Exactly.
Because you're right. If low rate market, if bank policies do change the lending criteria, you're not going to get to a point that you can maybe potentially access that equity as much as you would have done before.
Exactly. And I think, look, people always wait for the perfect opportunity, right? There's no perfect opportunity. You find the best opportunity you can today.
I mean, that's interesting. You wait for the perfect opportunity, or you go and find the perfect opportunity. If you realize that this money's not working for you in any practical way right now, it's not paying into your bills any further, it's time to go to Financebetter and actually understand how this project, or how this equity fits into my wealth creation strategy.
Yep.
Because it's just a number out there unless you're using it.
Correct.
Right. And you're saying 30 years down to 7 to 9 years for a full payment or full payout of your mortgage, which means full ownership, which means more equity, which means more borrowing capacity, which means higher potential for wealth. Right.
Yeah, 100%.
So, I mean, that's interesting. You come over here, you kick the ground with us, you see what we're doing over here. We've brought in a couple of very, very innovative ways for Australians to do it at their own pace, or at their own, I guess, at their own confidence level. Of course, we want you guys, if you're watching at home, we want you to come over to Bali. Let us show you what we're showing you on Zoom. You've seen it now. The two major components that have helped us help Australians are that interest paid during construction. The light bulb moment for you?
That was a light bulb moment.
Yeah.
Absolutely.
Because right now, if you were to, let's do a construction in Australia, then you've got to make the repayments, obviously, on the interest cash out.
Yeah.
Then you've got to make the interest repayments on, obviously, the time it takes to build.
Mm-hmm.
And yes, look, like at the moment right now, it's a bit challenging to build in Australia just because of labour and the cost.
And it could drag out, couldn't it?
We've seen some clients like, build out in 2.5 years. And at that point, like,
there's actually not a lot of things that clients can do because you're just waiting for that dwelling to be erected. So yes, to have those payments as effectively month on month until the building is erect, so they can take care of the repayments on the equity or cash out that they've done. That's a massive thing.
Yeah.
I was just going to say, it's almost a no-brainer.
Yeah.
Right. To have something already positive from the day that...
From the moment you invest.
From the moment that you invest, and for it, to not even be complete yet and already getting a return. You're printing money, pretty much.
Yeah.
Right.
That's right. The next thing that was obviously a game changer for us. It's been a game changer for many, many, many clients. We have, obviously, I'll take you through the customer journey, right? They come to Bali, they see Bali, they love Bali, they want to take a piece of Bali with them. They come back year after year, sometimes 3 times a year. And that's been going on for generations. Now, they find us on social media. They flick, go, yeah, I love the investment opportunity, but don't know where I sort of fit into it. I don't have a lot of money. I have a little bit of equity. That's not even playing in their thoughts, right? We fractionalized the game. We're literally taking singular pieces of property, villas, units, apartments, hotel rooms, hotel suites, townhouses, and all of that. We're taking them down into fractional bite-sized pieces. Your thoughts on that?
Well, firstly, we didn't know about the Fractionalize until we came here.
Yeah, right.
I thought the acquisition of Bali was the whole thing. Yeah. Right. Again, a lot of those stuff is not open in. A lot of those opportunities are not in Australia, where we could kind of fractionalize. So we were coming into Bali thinking, okay, cool. Well, you have to acquire the whole thing. Yeah. And to understand fractionalize, and for you guys to fractionalize, I was like, wow, that's fantastic, because not only do you get people that's maybe trying to grow their cash flow, but maybe grow into their savings position, but they go, okay, cool, this is a little bit of equity that I have. It's not enough to acquire the whole, villa, apartment, unit, etc., but just enough to acquire a certain percentage of it. Was again a bit of a game changer, because we were like, okay, wow, so you could own a piece of it, still get the return, which is great. Nothing changes. And it's where we're comfortable at. And yes, a lot of potentially even our clients are going to get to a point that they're going to be like, I'm not comfortable acquiring the whole thing, of which we go, there's nothing wrong with that.
So what we're seeing with our clients is that they're taking a piece of this, piece of that, piece of the other, right?
Yeah.
Because this is also a lifestyle choice in an investment strategy. People love Bali. They want a piece of Canggu. They want a piece of Barawa. They want a piece of Seminyak. They want a piece of Uluwatu.
It's great diversification.
Yeah.
I think so, yeah.
And you can stay in each one of these properties, even if you're only a fractional investor. So when I say stay, of course you can stay there. You can stay for free.
Yeah.
For a certain amount of days per year. It won't affect your return on investment. You are an owner. You're always treated as part of the investment team. And you have a legal document, a lease agreement, and a management agreement, making sure that it's a hands-off investment. And part of your investment strategy should be tax depreciation.
Yep.
Of course.
Right?
Yep, 100%.
You've seen our tax depreciation schedules. They're generated by Duotax. Work us through how tax depreciation works in an investment strategy.
Yeah, look, I think, especially if you're buying something brand new, right? You can depreciate, well, in the first 7 years, you can depreciate as much as possible. So I think that's always been one of the strategies for our clients in terms of tax effectiveness, is getting high depreciation schedules. And we work with Duotax as well. Yeah. We've seen the work that they do, but I think getting into these investments and on that point of fractional allows you to get in earlier, allows you to diversify as well. I think the hardest thing for some people is to think, well, hey, I've got to go all in. I've got to put all my eggs in one basket. And then they start to and but, well, you can have them both. You can go here and there. And depreciation is one thing that you're not going to get as effective if you're buying, let's say, an established property or an older property. And so I think, absolutely, it's a strategy play there with some of the developments that we've seen over the last couple of days. So for those that are starting to hit a certain income threshold and they want to scale it back, then that's one of the ways to pull back on, as well as still earning a great ROI as well. Because some of the ways that Aussies do it is they try and find heavily negative geared properties, but the reality is you're losing money.
Yeah, that's the reality.
At the end of the day. Yeah. And that's the trade-off. But I think in this instance, you can have good cash flow.
Good cash flow.
You can still
writing it off.
Yeah, exactly. So again, makes sense.
Makes sense.
Yeah.
Makes sense. I'd like to discuss something else that we're seeing probably 20% of our clients use. And you guys are heavily into this, and we're going to be leaning into you guys a lot more for the guidance for some of our clients. Self-managed super funds. It's actually here, self-managed super funds on the website. How does that come into play when it comes to property, and specifically a Bali property?
Well, we'll probably break down SMSFs, and I'll go to my section. So borrowing capacity has been restricted, especially outside of SMSF, right? So let's talk about outside first before we can talk about inside. Outside of SMSF, if you've got too much lending, too much whatever going outside, and your borrowing capacity is capped, there's nothing really else you can do. The beautiful thing about SMSF is, even if you got $100 million worth of debt sitting outside and servicing is an issue, and you still really wanted to invest, you can go inside your SMSF. Obviously a financial planner and accountant, and you can establish your SMSF to then invest with that SMSF. And the good thing about that is
it's a different entity.
Different entity. It's got nothing to do with outside of your SMSF. And yes, we could definitely use that to lend against borrowing, although you could use that SMSF to again invest in whatever you deem as a correct investment for it. So yes, the popularity of SMSF has really come out over the last 12 months, pretty accelerated because of borrowing capacities outside. Because people are still wanting to invest pretty heavily and going, what do? I still want to do this. I just can't outside. And they go, oh, wow, I've got 200K in SMSF, not really doing anything with that. I'm seeing my returns that I'm getting on these, and these funds, and I want to start controlling that for myself and seeing this as the right investment for me. So yes, to go towards SMSF. Yeah.
You guys have gone, you've built your team to handle people wanting to change from superannuation to self-managed superannuation or self-managed super. What should our clients know about you guys from that perspective?
Well, I think, we're really, really proficient in self-managed super fund. We've built the A team around the establishment. We've got a really good accountant that works with us. They can set it up in effectively record time. We've got the lawyers that can set it all up as well. But we've been doing self-managed super fund for a long, long time. One of the things that we've done in our business, which actually you probably touched on a little bit earlier, is we've built this business really mindful of having a growth mindset. Once upon a time, and probably even still today, the perception of self-managed super funds, perception's been complex. Oh, it's all too hard. But the fact of the matter is, it's once you can articulate it right and understand it, it's actually
pretty easy.
Pretty easy. And we've been doing that. We've been doing it for a while as well. And again, going back to the point of helping our clients realizing the potential that they have. Some clients think that they're just capped into their personal names and their borrowing capacity, but then you start to realize, well, hey, you've got more opportunity here in your.
Remember the creative conversation we had earlier on? That's part of thinking outside the box. Of saying that is creatively, what else can you do? Actually, there's an SMSF here with a significant amount of money, not doing nothing, with terrible returns that you can't control. What are you going to do about it?
Financebetter refuses to be an order taker when it comes to finance. We're here to diagnose the client's financial position and present to them with options, to address the immediate need, but also options in what they can do. So, and many times our clients like, wow, we didn't even realize we could do that. And so the journey starts.
Great. Guys, we're going to have to finish it there. It's already 45 minutes. You've got a plane to catch.
I do have a plane to catch.
Wow.
Yeah.
Sorry about that. We got off on a few tangents, but it's really important that we have you guys here. You're a huge asset to us and our clients.
Appreciate you.
From the bottom of our heart here in GeoNet, and also from obviously to all of our clients. We want to make sure that we have partners like yourself attached to the team. You will find us soon in the same building.
Yeah.
Okay. Here is
It's like we've got a Financebetter. I think which is perfect avenue for it. Yeah. So there's going to be a Financebetter team here in Bali, and we'll build this out to be our second office outside of Australia. So I'm pretty excited with the diversification in our business to help better all our clients together.
We're really stoked to have you guys here, and thank you guys again who are tuning in. Appreciate you all for I guess taking the time to inspect your own wealth strategy. I encourage you all to set up a time with myself or straight to these guys. Okay, all of their details are on our website. Thanks for tuning in for another podcast. We look forward to seeing you again very soon.